To today's webinar by Apollo Capital. My name is Tim Johnston. I'm Managing Director, and clearly not Chief Technology Officer. But today's webinar will be an interview with an institutional investor. So this is a series that we've run over the years where we interview investors in the Apollo Capital funds to get an understanding of their thought processes, both in allocating to crypto assets and indeed Apollo Capital. Today's a special edition of this series where we are speaking to the first institutional investors in Apollo Capital's funds, being Lucerne Investment Partners. So I am joined by Executive Director Michael Houghton and Anthony Murphy, CEO. Welcome, Michael. Welcome, Anthony.
Thanks, Tim. Good to be here.
So today, again, like the rest of the interviews in this series, is just to get an understanding of the processes for people that decide to allocate to crypto assets. And I think the institutional setting will be a very interesting discussion. It is not financial advice. I must give the obligatory disclaimer. It's for general informational purposes, but we are very keen to hear your questions. So that's why we have recorded these previously as just recordings. But today is a webinar to invite some questions from the audience. So I think there's a chat function or there's a Q&A function. So either one of those questions will come through to me. We do have some dedicated time at the end, but indeed I might ask questions throughout as well. So yeah, looking forward to the discussion with Michael and Anthony. I think a great place to kick off, guys, is just to understand a little bit about the Cern Investment Partners and in the background. And Anthony, if you just want to kick off with some background, please.
Yeah, sure. Thanks, Tim. So we founded the business in October 2015, and at its core, Lucerne's a private investment group. So we believe in partnering our capital and our investors' capital with investment specialists within their respective fields. And one thing we like to focus on is identifying themes in markets before the rest of the market does. And obviously by doing that, one can do quite well if they get those themes right. So yeah, that's an approach we'll talk about today and how it's relevant to Apollo. But yeah, at our core business, we believe in partnering our capital with specialists in their respective fields.
Excellent. Right, so jumping into the questions about allocating to crypto assets, I guess quite a broad question to start. What was the initial thesis for investing in crypto assets?
So it's a good question, Tim. Probably because at the time, we've got to go back to when we first started thinking about crypto and when we first started discussing with Apollo as a manager of our funds. And that was December 19, January 2020. And I think our first meeting with Henrik was in January 2020. And then we had a couple of follow-up calls. And what became clear as an investment committee, because the fund that we run makes investment decisions at a committee level. We do all the due diligence and the analysis, Lucerne, and what became clear was there was some contention around the investment committee about investing in crypto. But what also came from that discussion and the way that we approached it was that the asset class actually has merit, and it had merit for a few reasons. Obviously, around crypto itself, around the performance opportunity that was there. And then the third piece of that was Apollo and its ability as a fund manager to provide our exposure to the asset class. I think too, even now, it hasn't changed a lot in that 18 months. Crypto assets are still considered a contentious, even though they're an emerging asset class. But they are at the frontier, well, in our opinion anyway, of technology, of finance, disruption, digitization, etc. And while they're high risk and speculative, it wasn't an investment that we were going to be making in isolation. It was something that we were going to participate in across what we have as a fund of funds in various alternative investments and various asset classes across those alternative investments. So it was also interesting from a performance perspective, because that was one of the concerns that we had. And how could we weather the volatility that was in the asset class. But it was interesting, two things that we got out of discussions with Apollo. One was that crypto assets were coming off a bear market at the time that we made the investment. So that was interesting to us. And we accepted the judgment and opinion of the professional participant in the space, being Apollo. And it was also, and probably still is the case, given what has been going on, but Bitcoin had still outperformed all mainstream asset classes over the last 10 years. So even with those contentious issues, with the volatility and with a lot of the concerns around regulatory, etc., it was still an asset class that had performed. And likely, in our opinion, that there was going to be a couple of aspects of that that would survive, even if there is, increased regulatory scrutiny, or some of them might fall by the wayside, as happens in lots of different asset classes. Some make it, some don't. So we saw the performance and the contentious part of it, but there was also then Apollo, who we saw as a very strong manager in the space. We liked what we saw when we were speaking with Henrik, and with the due diligence process that we undertook after that. And the fact that you were also managing your risk and you were taking approaches to different asset classes. You weren't actually investing in Bitcoin or one only cryptocurrency. You were across the whole digital finance space, and you're researching those. You were selective. You were acknowledging the volatility of the space. So there were lots of different catalysts, I suppose, that went into that. And the other piece, of course, is being an institutional investor, was we felt other institutions would end up investing there, because that's what institutions do. They look for ways to invest, different places to invest, and different ways to spread their risk and also increase and improve their returns. I've probably said a fair bit there, so I'll stop there and let you ask us another question.
Yeah. No, that's great, Michael. Thank you. And take me back to that or those initial or that initial investment committee meeting. I would have loved to have been a fly on the wall, not just because you were talking about Apollo, but also because crypto is polarizing, and some people love it, some people just don't want anything to do with it. But I imagine when you're faced with the investment committee, you can have different opinions. So what was the investment committee meeting like? I'm assuming it was not a unanimous decision, and talk me through how that worked out.
So I'll take that one. So I think, so I'm not to say it wasn't unanimous, and this comes down to how you manage risk with an asset class that is more volatile, and you could argue more opaque than your traditional asset classes, and emerging. There's no doubt about that. If you've been an investor in crypto 10 years ago, you're an industry veteran now. What we began to understand and appreciate, and I'm the first to say this, 3 years ago, clients who asked about crypto at the time, I'd be more stay away, and that was probably a little bit ignorant on my behalf. I'm happy to admit that, but what we did start to notice, Tim and the audience, towards the end of 2019, start of 2020, is that well-known institutions around the world started paying more respect to the asset class, and even establishing funds themselves and trading desks for this asset class. So I'm talking about the big guys around the world, the JP Morgans, your BlackRocks of this world. And once you start seeing that theme play out in the market, one of the questions that's come through is about regulatory compliance. That there's going to be a greater sense of, regulatory and compliance coming into the space as well, particularly because institution presence is bringing that, whereas historically, crypto, was more favoured in the family office market and limited institutional investment. And that's where the opportunity arises, right? If you get things right early, you can do much better than even institutions, much better than even Lucerne and our investors have done for being very early in the space. So that was the other point there. But so from an IC perspective, we knew that allocation was going to be important initially. So if you think about running a fund of funds, and we have 13 to 15 different underlying strategies, from digital assets through to resources, through to private equity, we can size positions appropriately that gives investors that level of diversification. So our position sizing initially into the fund was 0.7 to 1%. That was on day one, and we felt that as the theme actually pulled back a little bit between sort of May of earlier last year, pulled back, and that's when we added to the theme. So we feel so the actual decision was unanimous in the end, but it came down to how we sized that. So we didn't go 4 to 5% in the fund on day one, and later on, I think some of the questions here will talk to what that sizing actually got to eventually. But so it was unanimous from that perspective, and that was more just about the risk that we were taking at the time, and we were comfortable with that from a risk-adjusted return perspective.
Yeah. Okay, very, very interesting. There you go. I'm proven wrong, but I guess I'm sort of used to people being, crypto polarizing topic.
2 out of 3 of those decision makers are on this call at the time, so they're on this call right now. 2 out of 3 of those decision makers at the time are on this call right now. So
yeah. And so what you've sort of touched on, I think both through both answers so far. But how did the fund affect the overall performance? I mean, that might seem like an obvious question because crypto has performed well lately or since the investment. But we talked about how it was a small allocation, and then how was that allocation managed as crypto did perform quite strongly?
Yeah. Well, look, overall, because the fund itself and the underlying assets of Apollo perform well, it's been a positive contributor to the fund. But the way that the size was managed, as Anthony said, when there was that initial pullback after our first tranche of investment, we added, and then we added again. The performance, we did let it run for a little while, but then we had to manage that a little bit, as you know, Tim, because it was going particularly well. But it's also important to point out that we're managing a fund of funds, as I said earlier, and we have different assets, as Anthony alluded to, different asset classes, different types of managers. And the way we talk about how the fund performs is probably like a series of rolling waves. Each of those investments performs well for us, but they perform well at different times and not all together. I think, in fact, last month, July was the first month that the fund had every single one of its investments perform positively. So it's a pretty rare occurrence for that to take place. Apollo had its good months, but so did other funds that we invested in. And I think there was a couple of months, obviously just through the size of the return, where Apollo might have been one of the largest, if not the largest contributor to performance. But as I said earlier, those
easily the largest contributor some months. I mean, some months Apollo's 50%. That's easily the largest contributor when that happens. Yeah.
Yes.
Yeah, and as I was saying, but the way that we looked at the sizing and the way that we managed that and the way that we decided to let it run and so on is to do with not only those waves that I've spoken about and how the performance of other investments contributes, but also we manage correlation and we manage risk very closely in the fund. And one of the key things that's come through, obviously with digital assets as well, but is that our correlation is quite low, and the risk that we have as a result of that, not only is the correlation low to markets, but the correlation between underlying investments is quite low. So that allows us to, I suppose, carry sometimes a bit bigger position than we ordinarily would when something's going well. But likewise, we monitor that monthly as an investment committee and have lightened a couple of times since then, and we're down back below the 5% mark now.
Yes, yeah.
And just for the audience's benefit, to give you an idea about the benefit of being early, so to identify that we wanted to have exposure to digital assets, and we then identified, after doing this extensive research on this, that Apollo Capital was best placed in this country to manage that piece of the portfolio for our investors, was taking that initial position as and already sort of having an agreement at the IC level that if there was a little bit of volatility towards the downside in the space, well, that's when you'd be disciplined and you actually add to that theme. So, as Warren Buffett would say, buy low, sell high. Unfortunately, as investors, we can often get caught by doing the same thing. We want to get into a thematic after it's already run, and you've seen that with other stocks that everybody would know in the market. Let's be as simplistic as Afterpay. Everybody was buying it at $50, but not at $5. And if you think about, I guess the hype and euphoria around digital assets, it really only started in November, December last year, like that euphoric stage in the market, and sort of moved into earlier this year. So we felt at a 0.7 to 1% allocation initially that we would add to that. We did add to that. We doubled that allocation after a couple of months, and then we added to it again. So when we were fully invested in the position, it was about a 3.5% position in the fund when we were fully invested, and that grew to 11% position at the start of this year. So we were happy to be directional and have that as an allocation as that thematic played out. But then coming into March this year, when the market was incredibly hot, there's no doubt about that, that's when you do have to exercise some discipline as an institution. It's not about whether or not we think that thematic has more to play out. It's a responsibility we have as a custodian of capital when we are running a fund of funds that we need to manage risk in that space, particularly against an asset class that carries more volatility than other investments within the fund of funds. And to put that in perspective, we have a convertible note debt fund in the portfolio that's at a 15% weighting. So we were very bullish on digital assets and crypto to take that weighting to 11%. In saying that, what's also important to take into account is that we will be happy to own that theme to a high level again if fundamentally we feel that theme has further to go again in the market. And we could sit here today and easily be wrong that crypto doesn't have further to go, because we actually think it does, but we just need to manage that risk appropriately as an institution. Outside of that, to give you conviction that we still have about the fund itself, is often our clients will come to us and say, well, we like what you're doing within the fund of funds within LAIF, but what are some of your best ideas in the portfolio? And so we've actually had direct investment into Apollo as well from a number of our underlying investors. That would stand at about 10 to 12 today. And we've held that position strong all the way through, and we'll continue to do so. So that's where you do have that additional flexibility if it's at the individual investor level, versus you're a little bit more beholden, I guess, to risk management and discipline when you're within a fund-to-fund structure.
Yeah, fascinating, Anthony. I appreciated that LAIF and Lucerne Alternative Investments Fund, it started with a small position. I didn't actually realise it got to 11% of the portfolio, which I would have thought would have been at the higher end. So it's interesting to see that it did have that impact.
When your fund goes up, Tim, 50% in 1 month, so if you're at a 7% weighting, you're suddenly at a 10.5% weighting, all things being equal. So for all intents and purposes, that's exactly what got us to that weighting quite quickly. It was a 400% increase, as you know, in the fund, and congratulations to you guys, did exceptionally well.
Yes, and I must stress for investors, it's not always like that, but we do enjoy when it does happen. And so most of the discussion so far has been about the Apollo Capital Fund, which was the first fund you invested in, and more recently invested in the Apollo Capital Opportunities Fund. Talk us through that decision. Again, at the investment committee level, I'd be interested to hear the behind the scenes of that decision.
Yeah, that's probably a really good segue from what we've just been talking about. We're trying always to manage volatility. We're trying to manage the correlation of assets, but also we've got a return objective in our underlying, or in our fund for our underlying investments, that we'd like to be relatively consistent. And the Opportunities Fund presented that to us. It was going to take away, in our opinion, a lot of the volatility that we've been experiencing. It was going to allow us to size the investment appropriately, and it was also participating in crypto in a different way, and that was also very interesting. So when we were talking about it at the investment committee level, it was probably a far easier conversation than the first time we invested in the capital fund, because we've had exposure to Apollo. We'd met with yourself and Henrik several times. We'd experienced how the capital fund had performed. We started to get, I won't confess to having a great understanding still, but we started to get a better understanding of what the underlying investments were. And in particular, that you weren't investing, as I referred to earlier, just in one thing like a Bitcoin. It was actually a fairly risk-managed approach that you were taking to a very volatile asset class. The fact that we could contemplate smoother returns was very appealing. The fact that you were looking at it in a different way. I think I mistakenly likened it to a type of stock lending arrangement through the Opportunities Fund, but that allowed me, thinking of it like that, to get a better feel for what it was you were doing and how you were participating in the space, and also what you were allowing, I suppose, to take place in crypto investing without having to experience those extreme highs and lows. So that was where we came from an investment committee perspective. And again, Apollo have been very effective at managing the funds that we've entrusted them with, and we continue to want to support that.
I think also on that point, one thing we've always been pretty passionate about, and I've said this a few times on the webinar today, is being early to a thematic or being early to a theme. And you guys have identified that yourselves by starting the Opportunities Fund. And like any industry in the world, when one industry starts up and it's performing well or it's profitable, you get other entrants that enter the space. I mean, think about how many ICOs there's been now in the last 12 months, right? And many of them, unfortunately, will fail and some will be successful. But that's like any business you see out there. Buy now, pay later space. Afterpay was first to market. Look how well they've done. Look at how many buy now, pay later companies on the ASX today are actually underwater from their IPO price. We feel, again, with that thematic, obviously the IRR and the opportunities fund's incredibly appealing to us with that consistent return profile of 30% per annum. When we were making that decision at the ICs, it's just so you're aware, Tim, we looked at the perspective of, well, if more people do come into this space and operate in a similar space to what the opportunities fund is providing, even if that return profile dropped down by half for us, that's incredibly attractive still. So we sort of look at the downside case, if that makes sense. Like if you deliver on the upside case, that's an amazing result. But what if you only delivered on 50% of your upside case and our investors are still making a 15% IRR on that position? That's incredibly attractive to us, particularly with the return profile obviously being so consistent and almost linear in nature. Not to say it will be, but at the moment it is. So that also made the decision process a lot easier.
Yep. Very interesting. And I think you sort of both touched on it through your answers about the institutional interest in the space and how that is increasing. And I think you both touched on how looking overseas, we had some pretty impressive investors. What about from an Australian perspective? Your counterparts, other institutional investors, do you see these Australian institutional investors sort of warming to crypto assets or still a bit slow?
I would say still a little bit slow at the moment because I think the market as a whole, which is beneficial to Apollo, right? Because I think investors out there, there is a lot of individuals out there obviously going on to crypto platforms these days and trading, and many of them have had great success stories in the last, particularly 6 to 12 months, and I take my hat off to them. But it's an interesting space. Crypto as a whole of digital assets is still quite opaque. There is absolutely no doubt about that, and that's more and more when you actually do need a specialist. And Tim, not to say you skipped the question, but one question you suggest we talk about today was, why didn't Lucerne, so I'll answer your question a different way, why didn't Lucerne go and buy crypto and Ethereum, buy Bitcoin and Ethereum directly for our own investors? We're not for 1 minute going to profess that we're smarter than you in the digital asset space. If we're effectively not, and we never will be, and nor do we want to be. That's not what we specialise in. Whether it be digital assets or whether it be resources or whether it be private equity, we believe in allocating capital to those specialists because we believe fundamentally not only will they do well, but they'll outperform their respective benchmarks and they'll definitely outperform Lucerne. And it's also about risk management as well, particularly in an asset class like this. So I think the institutional space within digital assets is relatively underserviced still. And I think Australian as an investment market, when compared to, say, the US and Asia, is still far more traditional. And I think it will always remain that way. And you've got things like the franking credit system here that sort of underpins how a lot of Australians invest. And that's fine. And something that should be utilised effectively. But as a result of that, you have your more sort of emerging asset classes that probably don't have the same strength in following as you would, say, in the US or pockets of Asia. But that's the opportunity for you guys. And I think you actually can apply that. If you think about the long short of the hedge fund industry in Australia, you compare that to the rest of the globe. And this is hugely beneficial to Apollo and its investors. That there are only in this country sort of 15 to 20, decent long short or hedge funds, I would argue. And that's in an established pool of capital in a developed market in the ASX 200. You compare that to Asia alone, there's 3,500. So you've got a lot of people competing for the same pool of investment ideas. Whereas in Australia, the reason, if you compare the performance of Australian hedge funds versus the rest of the world, the annualised return in Australia is about 15% per annum. The rest of the world is about 6%. That put things in perspective. If you go and compare your results with a broader pool as well, in North America, Europe, Asia, and I haven't done this, but I think you'll find that Apollo is well ahead of other managers in those more, let's call them established digital asset markets. Yeah, that's where you've got the opportunity, in my opinion. Yeah.
I hadn't thought about it like that. It's a very interesting way to think about it, but it does make a lot of sense.
I'm trying to give you a comparison there against the non-traditional asset class as well.
Very interesting. So audience, please, I see some questions coming through. Please feel free to keep sending them. We do have one question from Peter Flanagan. Thank you, Peter, for your question. Question is about the regulatory environment and crypto assets. So how did Lucerne approach that sort of regulatory question? Was that a serious risk? Was it just a risk that you accepted? Yeah, interested to hear your thoughts on that one.
I think we probably looked at that, considered it, and decided that you were far better placed ultimately to understand what markets you should operate in, and to go back to
what ones you should avoid.
Yeah. Or avoid, yeah, and to go back to something I said earlier about one of the appeals of investing in or with Apollo, and also just from our own due diligence on the space, it was that while there will be some types of digital currency that will come and go and others stay, we saw Bitcoin, for example, as one that would probably survive. The regulatory environment isn't being particularly kind, probably more so now than it has been. But I think the more, and this is one of the discussions we had, the more regulated something becomes, then the more mainstream it becomes, the more accepted it becomes as well. So that was part of the thinking. And also, though, again, I just reiterate that Apollo was diversified in how it approached it. And, you know, particularly your exposure to the DeFi space, that was really appealing as well.
Thank you, Michael. And I think more broadly about the Cern, how many managers have you invested in? Maybe just a snapshot of some of those managers. And I think we should also mention that it is a retail fund with, I think, a minimum $50,000 investment, if I'm mistaken. So just a bit of background for some of the investors.
Yeah, sure. So our advisory mandate of how we've been providing advice or allocating capital has been pretty consistent since 2013. And as I said at the start of this webinar, that's identifying specialists in their respective places in the market and finding who we believe, you know, is the best small cap manager, the best digital assets manager, the best resources manager, and allocating capital to them initially, building that position over time as they do what they say and deliver. And then continuing to monitor them and looking for potential red flags if they come about, and also looking for new entrants into the market as well. You know, is there a new kid on the block that's better than the dinosaur that's been doing this for 20 years, for example, and being dynamic about that. What's ultimately important, or what we're very passionate about, is in this market in Australia, there's two types of investors defined by the government. One is called retail investor, which is the majority of the population. Another is what's called a sophisticated investor. And the sophisticated investor defined by the government is one has net investable assets of $2.5 million, or they've earned $250,000 a year in taxable income over the last 2 financial years. That apparently defines you as sophisticated. I can tell the audience right now that I have, you know, clients with $2 million super funds that are far more sophisticated than clients with $5 million super funds, but they're unsophisticated. So what was really passionate to us is that whether we like it or not, the majority of funds in this country that tend to do incredibly well over time and sit within that sort of top quartile are sophisticated investor-only products, which means that basically the majority of Australians miss out unless they can get access to something like LAIF. So when we established LAIF, we wanted to go through the process of having a retail compliant vehicle that would primarily invest in these sophisticated funds. So at the moment, there's 15 underlying strategies in LAIF. Apollo, one of those strategies, digital assets, one of those strategies. And of those 15 underlying strategies, 13 of them would be sophisticated only products. So it is providing those retail investors the ability to get access to things like Apollo Capital, to resources funds, to global quant funds that have been around for 35 years and annualised 14% per annum in that period of time. They're the different sort of strategies that we have in LAIF that even some sophisticated investors in Australia couldn't access because they have minimum ticket sizes of US $5 million to invest in these funds. So basically it precludes everybody. So it's something that we're quite passionate about, Tim, and us we're passionate about, because I think all investors, regardless of the size of their wallet, should be able to access these pockets of the market.
Great. Thank you, Anthony. A viewer question here. How does Lucerne monitor the portfolio and manage the custody of client funds with Apollo?
Yeah, well, being a retail fund, we've got some pretty strict regulatory and compliance obligations. It's it's what's called a registered managed investment scheme. So it's under the supervision of ASIC. We have an independent trustee, which is perpetual trustees. We have the fund audited by Ernst & Young or EY each year, and our administrator and custodian is Mainstream and JP Morgan. So that's how we hold all the assets in the fund and how we monitor and scrutinise all the day-to-day and regulatory requirements. But when it comes to Apollo's custody, that's where our due diligence comes in as well. So we look at who Apollo use for their administration, for their custody, and how they go about ensuring, I suppose, that our capital is looked after as well. So we can get the same level of comfort and pass that through to those that are responsible for looking into what our fund does and how it's managed.
And every month, obviously, so our net asset value or our fund reports every month. And so literally the process we go to when the month finishes, so September's about to finish today, over the next 3 weeks, we have all those underlying managers and strategies, including Apollo, that provide us with their audited NAVs at the end of each month. And that's when we're able as a collective within 3 to 4 weeks to update our investors what that final NAV was. So yes, all funds are formally audited on a yearly basis, but it's actually sort of a monthly process that happens every month as well for the investors' benefit out there.
Another viewer question here as we sort of wrap up in the next 5 minutes or so. Interesting one. What was the hardest IC question or the final position Lucerne needed to overcome to eventually invest in Apollo?
Wow, that's a good question. The hardest one, I think, it probably came down to who was Apollo, and how do we get our comfort around Apollo and their ability, and how can they manage it? And that was a good way to approach it too, because it was an area that we hadn't invested in. And it goes to the earlier comment about rather than buying directly, how else can you participate? But then when we met with Henrik and then spoke with yourself and went through the DD process, which just to give 20 seconds on that, it's a fairly comprehensive qualitative and quantitative undertaking when we do due diligence on a fund. We interview the people involved, including the portfolio manager or the administration. We actually ask a lot of questions that people probably don't necessarily think about typically. Including, how much money does Tim have in the fund and how aligned is he with the rest of us, through to, what would happen if one of the key people was no longer in the fund, what would happen if you had a drawdown of so much percent, etc. And that's all contingent upon the people that we're trusting to manage money, in this case, Apollo. So that probably was the hardest question, is how do we get comfort around the manager being able to do what they do it well, and ensure that we've got a long investment.
And I think to Michael's point there as well is that if things didn't go well, as I said, it is still a relatively new and emerging asset class. If things didn't go well, could we comfortably stand in front of our investors and say, well, this is the process that we went through? Because it does carry more risk than a traditional, say, long-short equity fund. And so that's probably a question we'll ask ourselves as well. What if one of our underlying clients that was after for 10 years turned around and said, well, why the hell did you go and invest in digital assets or crypto? We need to have a very strong investment thesis in case to justify making that decision. And it's funny, right? Because most of our underlying investors out there who tend to be self-managed super funds or retirees, they're not going to often directly go and invest in, say, something directly like Bitcoin. But I think one thing that's actually really impressive is that they're able to actually own an allocation to that space via LAIF, and from a percentage in their portfolio, it's 0. At its largest exposure that we held within LAIF, it would be, say, a 0.5% exposure to some of our clients' portfolio, or 1% exposure at its peak. And just to answer another question that came through from Brad, do we take our macro considerations into portfolio construction? Yeah, absolutely. So one of our independent IC members that many of the audience out there would know is Mugundan Siva. He runs Australia's only direct equity fund into India, emerging companies in India, but very well known on Livewire and other media out there as well. So Mugundan puts a piece to our IC every month on his view on the macro environment, and so it's always our first point of discussion when we meet monthly. And by way of example, at the moment, a theme that we're really concerned about is general equity markets and just how expensive they are. And if you think about that, the US share market at the moment is 2.1 times the size of the US economy. and it's trading on a PE ratio of 21 times. And so we are concerned about general just long-only equities, just buying the equity market at the moment. And so a way to actually, to answer Brad's question a different way, to actually take a risk off there is you start looking at volatility strategies where effectively you're buying insurance against the market coming off. And so some of the best managers that we know last year had very strong positive months in March when the world collapsed, because they could see that if COVID did spread to the Western world, and if your audience remembers, in January last year, the market was up 7% and everybody knew about the virus. The market only collapsed when the US and Italy started to get infected by it. And so some of our managers were able to go and buy this insurance at the time. And like when you go and buy a car, you buy insurance in case you crash it into a wall or someone else. It's the same with portfolio management. So at the moment with LAIF, we're actually starting to add to a volatility strategy where effectively we're paying a risk premium. But if the market does correct, that position will go up multiple times and provide an underlying benefit and hedge to our investors. So that's starting with that macro view on how we're feeling about the markets. And then, how do we go and allocate the portfolio once we take a consensus view on that macro outlook?
And I think last question, as we near the get close to 11:45.
And Tim, we're happy to answer other questions as well. If you want to send them through later, we can email the audience directly. That's fine.
Yeah, good point. So that was I'll follow up at the end with how to get in touch with Lucerne if interested. But one last question, which I think is quite interesting, with the influx of institutional investors into digital assets and DeFi. How do you guys think about correcting the current market inefficiencies and potentially reducing the long-term efficacy of potentially both Apollo's funds?
Is a question referring to as more instos come into the space, is the space going to be less profitable? Is that what it's referring to?
Yeah. So one of the things that we talk a lot about is that the crypto markets are inefficient because they are mostly retail driven. So as more institutional investors enter the markets, have you guys given much thought to those inefficiencies being competed away?
Yeah, look, it's interesting. I think regardless of more institutions coming into the space, this is still such a young market. Like if you think about how long equities and bonds and cash and property have been floating around humankind for compared to digital assets, we're at its infancy. And there is going to be so much technological change in this space as well. And there's just a newfound of respect for it as well. But in terms of actually volatility, I'll answer the question a different way. What I would recommend, without providing advice, investors should be considering is, do you want to chase that high level of risk within the space? Or do you want to stick to those front runners and early emergents in the space? And my answer would be towards the latter, because I do think you'll have a lot of entrants coming into the space that won't survive or get swallowed up, because it is, as you said, it's imperfectly priced at the moment. It can be disruptive. But overall, we would prefer to align ourselves in a diversified approach or with the large players in the space, because I do think they'll survive, and ultimately I think they'll flourish. And you can apply that science to a company like Nike. Went into the GFC with global market share of 40% of the sporting apparel market. They came out of it with 50%. They just went into COVID last year with 55% and now 60%. So it's actually as larger players that can do well when there is a disruption in the market.
Very good. Michael, Houghton and Anthony Murphy, thank you very much for your time. Really appreciate the insights. I've been dealing with you guys for nearly 18 months, 2 years now, and even I learned a lot today. So great to learn more about Lucerne. How can the audience get in touch with Lucerne if they're interested?
Yeah, sure. So our website address for LAIF is laif.com.au, so laif.com.au.
Sorry, laif.com.au.
laif.com.au, and then on just how a general approach to advice, that's just lucernepartners.com, and all our details on our website there. And I'm obviously happy to speak to investors if they wish to learn more about Lucerne. And look, I appreciate everybody dialing in today. You've had a fantastic audience and a great turnout, so kudos to Apollo Capital and the results they've delivered for their investors today, and the results I'm sure they're going to continue to deliver going forward.
We certainly hope so. Thank you, Anthony. Thank you, Michael. And thank you, audience, for tuning in. And if anyone does have my details and want a direct introduction to Anthony or Michael, please let me know, and we're happy to facilitate that. So yeah, Anthony, Michael, thank you again for your time.
Thanks, Tim, and thanks to the audience. Really appreciate it.
Thanks, everyone. Cheers.
Bye.